Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark discusses the equity market outlook for the second half of the year. Real estate consultant Ross Kay tells us the first cracks are showing in BC's real estate bubble. We'll talk to Ross Clark right after this.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always enjoy being with you, Jim.
How have the markets performed for the first half of the year?
Well, it's been a very interesting first half. Some of the markets had a lot of volatility with little direction to them. Other ones had these exceptional moves, such as we saw over in the precious metal side of the equation. And we take a look at, for all that the equity markets in New York and Toronto had a lot of thrashing around during the process. New York overall, it ended up as being up 6% in the first half of the year. You got Toronto doubling that with the action that we saw over the materials section, whether it be in the base metals or the precious metals. It's and that wonderful recovery in the oil market, which clearly has abated, but it made for a pretty good first half of the year. And when I take a look at how we finished off the period just around the end of June as we went into Brexit, things you got a lot of pretty important reversals that happened. The gold market peaked out in the days just following Brexit, and so did the bond market. The bond market had what we classify as an upside exhaustion on the weekly charts that we look at, only 17 times in 40 years. So this big bull market in the bonds that we've had since the early 1980s, you see these infrequent excess levels on the upside as you get that flight to safety, as everybody wants to, it becomes more and more cautious and becomes anxious about items such as Brexit. And the period after that, it becomes fairly reliable when we look at the equity markets, because as that money now starts to work its way back out of bonds, and bonds are down about 4% now following the Brexit vote. You see that the equity markets become very, very buoyant during that next phase. And if I look at the 2-month stretch following those upside peaks in the bond market, you see that there's, of the, 17 examples looking at them here, there's only 3 where the next 2 months saw a decline of 10% or more in the stock market. Most examples, the market was either flat to higher, or at the most would give up 5 to 7%, which would imply that as we move through the latter part of July here, in through the latter part of August, that you really should be looking for that Brexit low that we had in the equity markets to hold pretty well, and we should hold well above that, more towards the breakout levels that we've had on the Dow and the S&P.
What is August looking like?
Well, the norm here, as I look at it from a seasonal perspective, fits in with this modeling, that you would tend to see your first you invariably get a summer rally. So we've got this good momentum move that has carried us for the first half of July, starting to see a bit of a corrective process. And so we've created some nice overbought readings in things like our MACD oscillator or the relative strength index. And it would be normal here for us to settle back and then have a second rally in through August that possibly goes to a higher high than we've been pushing into right now, but with lower momentum in it, so that it's got more of a rounding effect to it. And then as we push out past Labor Day you start to look for the markets to settle back down from there. So, okay, the window is probably, as I say, maybe 5% corrections off the high as we move through August, and a deeper correction once we're past that.
Are we going to have another Black Friday in August like we did last year?
They're more common than you would think. I have looked back on it, and probably a third of Augusts have had significant breaks during them. The one last year was in magnitude was fairly large, into the 24th there. I would suspect that you're looking at something smaller than that during the summer. I don't, other than black swans, which is exactly why they're called that, we don't see anything on the near-term horizon that could cause that type of a hiccup. I would think you're looking more into the September-October window out there.
Precious metals have had a great run-up this year. Is that going to last?
Well, the bullion bottomed out the early part of December. The miners started their move a month or so later, and we're now 26 weeks into this run. And if I look back, all the way back to the Second World War, and you take a look at bear markets that have come to an end, and then the ensuing early part of the bull markets that come out of that, there is a 26 to 29 week window where you tend to have that first move run out of steam. We've just finished the 26th week, and in the process of doing this, we had a minor correction into the middle of the week, and it's the first time we've seen the mining indices, the GDXJ, the GDX, and in Canada, the gold index here, correct below their 20-day moving averages. And in terms of where we sit in this run, that move, that first sign of weakness here in our work would imply that the next rally, the one that we're probably going to start here and take us in through the latter part of July, maybe the first week of August, that would be that 27 to 29 week period. That's probably the one that precedes the 20 to 25% price cut that we envision as the first good correction in the bull market that started here at the first part of the year. Most of these bull markets in the precious metals have one really good correction in that first year to year and a half, and this one looks as though it could be setting up for it.
Ross, thank you so much for chatting with us.
I look forward to it again, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. If you'd like to email him, his address, ross.clark@cibc.ca. Coming up, real estate consultant Ross Kay on This Week in Money.
Always consult your investment professional before making any investment decision.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Ross Kay from The Wealthy Homeowner, online at thewealthyhomeowner.ca. He's speaking to us from Burlington, Ontario. Ross, welcome back to This Week in Money.
Thanks, Jim, and I also want to thank you for mentioning our consumer website. So I appreciate you saying that.
Can you maybe just tell us a little bit about The Wealthy Homeowner?
The Wealthy Homeowner is a series of programs that have been created for Canadian homeowners. It allows them to grow their home equity wealth in a way that has never been possible. We've taken 40 years of interactions with homeowners, my family, so it's 3 generations. We have compiled that data over the last 40 years, and we finally put it into a package that allows someone to own their home in the most economical way possible. So what the wealthy homeowner does is you become a member of the wealthy homeowner. We currently have over $3 billion in home equity assets under management, and we grow your home equity in a way that no one else has ever even thought about doing. So we take advantage of every opportunity possible for you to keep as much home equity as possible, and then we give you opportunities for you to grow your home equity. If we don't do what we say, you get your money back. It's as simple as that. It is a zero-risk strategy for the homeowner.
Ross, today we want to talk about Vancouver and BC real estate. Do you have an update on the state of the Vancouver and BC real estate markets?
You sure do. And I was on the news down there. They had reached out to me, so some of the listeners may have heard me speaking, but your real estate market has turned. Contrary to what everyone's heard in every newspaper across British Columbia about your housing market, your market turned in June towards the negative.
How does this data show a housing market bubble that's starting to burst?
Well, the first change as a market swings. So, as I've told you here before in the show, we track the trading cycle. Vancouver's trading cycle started back in May of 2013, as did British Columbia's trading cycle. And what that means is that at the peak of the cycle, we measure a peak not by the price, but by the number of first-time buyers in the market. So at the peak of a trading cycle, first-time buyers' share of the total home sales is the highest. Generally speaking, you get of every 10 sales, 3 to 4 are going towards first-time buyers. So Vancouver and British Columbia in May of 2013, well, actually the month before, it was April of 2013, they had reached their highest number of first-time buyers included in the sales mix. That also means at that moment in time, your year-over-year price gains should have been the lowest, which is exactly what they were. In the intervening 3 years, 36 consecutive months, first-time buyers' share of the market has decreased in both Vancouver and British Columbia. When the first-time buyers' share of sales decreases, obviously, the average selling price is going to increase. And it increases ongoing, until it can no longer mathematically take place. That's why in June of this year, 1 month after those crazy records they told you about in May, house prices turned towards the negative in British Columbia and Vancouver. What do I mean by that comment, Jim? What I mean by that comment is this. In May of 2016, Vancouver was on pace to report a 17.27% increase at the end of the year. In 30 days, that dropped to a 16.61% increase. That is the first decline in year-over-year estimated gains since May of 2013. So when you heard those crazy house price reports by Royal LePage, what all of your listeners should understand is that at the end of June, house prices were only increasing at 16.61%. They are now dropping off of that rate. So now you're looking at a total gain, best case scenario, year over year, by the time they report in December, of being being 13% higher year over year. I think you heard universally from Royal LePage, Real Estate Board of Greater Vancouver, every single newspaper in British Columbia, every single media outlet, they were talking about 30% house price gains in the year. That was either a lie or they're using numbers that they're pulling out of a hat somewhere because it's got nothing to do with the homes that sold.
Based on your data, how much should the average home price drop in Vancouver and in British Columbia?
Okay, so now we're talking about housing bubbles, which is another discussion. If I'm going to ask you a question, Jim, and see if you can give me a response. Where do you think home prices have increased more based on all the news reports you've heard, all the staggering increases you've heard in the since May of 2013? Have prices increased more across British Columbia, or have they increased more in Vancouver?
I would say west side of Vancouver and West Vancouver.
Okay, so Vancouver. I think you're going to say that give the same answer everybody gave. It was Vancouver. What your listeners will be shocked to find out is, no matter where you went in British Columbia, the average selling price has increased 37% since May of 2013. In British Columbia, it went from an average of $509,422 in May of 2013 up to $698,176 in June of 2016, for a 37% increase. In Vancouver, your average selling price went from $728,491 in May of 2013 to a staggering total of $1,002,891 in June of 2016, 37% increase. The wealthy homeowner is told how the housing market is functioning at a given moment in time. So what that means is that they know where their home price is headed. They can take advance notice and decisions based on where the market is headed. So not only do they purchase their home, own their home, sell their home in a different manner, but our clients in British Columbia are the only homeowners in British Columbia who were told Vancouver housing prices in June on a year-over-year increase have only increased 16%. And that all this other crap that they're hearing in the news is an outright fabrication of the truth.
Is that because the prices in West Vancouver and the west side of Vancouver were so high? I mean, we had a property go for $31 million. That gets headlines. You don't get much of a headline if somebody's property goes from $750,000 to $1 million.
Correct, Jim. What you just said is the right answer, but no one can explain it other than Ross K. Realty Consultants, who now provides that intelligence only to wealthy homeowner members. So we know the only thing that matters in terms of how a housing market is going to function, or how a housing bubble pops, or how the number of sales are going to increase and decrease. It's related to the average selling price. That's why across British Columbia and Vancouver, it has been the exact same 37% increase. Now, yes, Vancouver, the greater Vancouver area, it's taking up about 43% of the sales across British Columbia. So yes, of course, there should be a certain correlation with house price gains during a period of time when one market's eating up 43% of the sales. But don't forget, 57% of the sales are happening everywhere else across British Columbia. So there is no way it could be exactly 37% increase. In May of 2013, house prices were actually decreasing in British Columbia. They had fallen 5.6% year over year. In Vancouver, they were down 5.7%. You're never going to hear that from a real estate board. You're never going to hear that from Royal LePage, the franchising company, which is not a real estate company. You're never going to hear that from RE/MAX, who their CEO just left it to manage a real estate office here in Ontario Atlantic, Canada, RE/MAX's strongest franchise grid in the world. you're never going to hear this. What you're going to hear is they're going to talk about 30-day windows of selling prices, which only go to confuse consumers and allow consumers to make bad choices. The truth, the real numbers, the data that the real estate boards themselves would produce say there has been the exact same increase. Housing prices in Vancouver right now, in the month of June, year over year, were up 16.61%, and in British Columbia, they were up 15.72%. Both markets correct. What that means is that your housing bubble is now deflating.
We'll have more with Ross Kay next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Ross Kay, a real estate consultant from thewealthyhomeowner.ca. Ross, is it too early for the overall psychology of the Vancouver and BC housing markets to turn negative?
Oh, you are going to see such a massive and mammoth change, and it's already taking place. So we have, which was mentioned on your show before, over 10 years ago, we created what was called the home engagement index, or home ownership engagement index. That measures activity. That gives my firm a 6-month lead time to know what's going to happen in your marketplace. So the price point, the decrease in prices that were recorded in June, we were actually forecasting those to happen in July, about the second week in July. So they've really happened about 3 weeks earlier than what we forecasted. That forecast was made way back in November, because what we monitor certain levers or triggers in the market and certain actions by certain parts of the home ownership base. And from that, we're able to extrapolate what we forecast is going to be activity levels going forward. So we knew activity levels were still going to be busy in May and June, but we also knew that they had been slowing active engagement numbers on activity rates. In other words, the number of sales was still increasing. That is an indication of a house price starting to decline. What you're looking at in Vancouver, directly to your question on psychology, everybody believes in Vancouver, in the back of their mind, that there's a housing bubble. Everybody believes that because the OECD, the Bank of Canada, the Minister of Finance, the banks, everybody has been speaking recently about them, but the housing bubble has been talked about by experts like The Economist in the States, Wall Street Journal, the IMF. All of these people have warned Canada about their housing bubble. So in the back of everybody's mind, which we profile our homeowners out in BC as we do across the rest of Canada, they are afraid of this housing bubble popping. The only people who aren't afraid of it are those waiting to buy their first home. They want it to pop as soon as possible. But all of the homeowners in Vancouver are really, really nervous. Now, what happens if the factual numbers that I just gave you had been reported in the newspaper, on television, Global, CTV, CBC, the fact that the pace of price or the year-over-year change decreased for the first time in 36 months in June, versus everybody hearing, oh, it's a 36% increase. Royal LePage saying, oh, house prices are going to go up 27% by year end in Vancouver, which, by the way, is a mathematical impossibility. And I mean impossible. you would have to have a 40% surge in house prices on the price of houses that sell in the second half of this year to reach the number Royal LePage just told the public, tried to get the public to believe was going to happen. So psychology is the only thing that drives the housing market. You are going to see such mass panic, and it's already begun. How do I know it's already begun? Because over 15% of the homes in Vancouver have had a price reduction in the last 2 months. You are seeing multi-million-dollar properties that have had reductions by as much as 30% in their asking price, and those properties still have not sold. Even in that coveted $1 million range, the average reduction that's taking place is 9%. Normally, or what you've seen for the last little while, those price reductions never happen. They started to increase in March, and they've intensified each month. So, what happens when all of a sudden everybody in British Columbia and Vancouver hears housing prices have actually dropped? Now, real estate board's not going to tell you the prices have dropped till the end of the year. And then they're going to hide it by saying, oh, we still had a 13% house price increase. Not the 36% we experienced early in the year, but we still hit 13%. Not too bad. Then January and February happened, and because in a declining market, the real house price depreciation isn't seen for months after when it had already happened, because how real estate data is released to the public. The panic is going to be unbelievable, Jim. So the psychology, yeah, it's going to be massive, because, and it's that psychology in the end that always causes a housing bubble to pop. It's that one, the fear of getting caught, the fear of losing money. You've got all these foreign investors in British Columbia that were actually buying homes right up until April. Oh, you're probably wondering, Ross, what are you talking about right up until April? Because we haven't heard that anywhere else. Is that a fair statement to make?
Well, I was just going to say, how come we haven't heard about this in the mainstream media?
Because they don't know how to measure housing markets. If you go to the real estate business school, you call any of these guys who are doing all these seminars, or all of these guys that are doing with the politicians or the professors, and you ask them what a trading cycle is, they don't even know what the hell I'm talking about. Excuse my language. They don't know what a trading cycle is. They have no idea why house prices stopped from May of 2013 till June, or till May. We'll use May because that's when the prices, right after that, the prices went negative. Why housing prices escalated? They have all these claims about supply and demand. It's because, foreign money. Yes, foreign money was added to the Vancouver real estate scene. That's true. It's far higher than what your Minister of Finance reported earlier with his up till June the 29th report. Why he missed the most important day of the entire year, June 30th, why the foreign buyers from June 30th weren't included in his data, I have no idea. But what I'll tell you is, when that data gets released, everybody's in for a shock, because that June 30th data has far more foreign buyers in it than the data that from the 1st to the 29th of the month. What people don't understand is, in the month of June, the reason why house prices decreased from 117.27%, or excuse me, from 17.27% to 16.61%, is because there was only $500 million of capital filtered into the Vancouver housing market. Only $500 million. Back in March, back in April, it was $2 billion. The reason why the $2 billion happened then, and it didn't happen in June, was because foreign buyers were buying houses still in April in March and April. And then all of a sudden, in May, they started to withdraw. And then by June, the withdrawal is unbelievable. So as we see July's data roll out, right now we are only forecasting about a $450 million capital infusion into the Vancouver market versus the $2 million that had been going on earlier this year.
Historically, when real estate bubbles burst, what kind of economic damage do they cause? Do they affect commercial real estate, and how fast can it happen?
So first of all, historically speaking, each real estate bubble is unique. Canada's real estate bubble of 2008 was starting to collapse. So we should have had a correction back in 2008, similar to what the Americans had. Everybody who gives you any other suggestion otherwise is a nut. And what I mean that is that they clearly are not qualified to comment about real estate, how housing prices change, or about real estate. What the federal government in Canada did, which the American government did not do, is Mr. Flaherty decided to increase amortizations, lower the threshold of down payments, and try to spur on the Canadian economy by getting housing prices to increase. House prices increases for an economy are the number one wealth accumulator for the citizens of a nation. The staggering house price debt that you see in Canada today has a flip side. It was the result of house price gains. The worst thing that's going to happen is that when the market goes negative, as it's turning now in BC, and how quickly, is that all of that capital is no longer available, and the ability to get more capital, the ability for Canadians to assume more debt, is basically wiped out. So you're in a position, our country is currently in the position, in this specific housing bubble, where other than interest rates going lower one more time, and even that, it would only give a little revival to the market, if at all. And they would have to do that relatively quickly to stop the psyche from consuming the Canadian consumer. And then this Liberal government would have to say, we're going to stall the correction until the third or fourth year of our mandate, which would be political suicide. This bubble is popping at the very worst time in Canadian history in terms of how economic activity is being generated.
We'll have more with Ross Kay next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with real estate consultant Ross Kay from thewealthyhomeowner.ca. Ross, do you think there's another Bank of Canada cut coming, or have they cut as low as they can?
They could cut. I don't think the Bank of... I'm not an expert in that area, so really for me to say something, it's only an educated guess. What I'm more concerned about, though, Jim, is that when a housing bubble breaks, and the entire world has been waiting for Canada's to break, what risk premium are other countries going to require of Canada on our debt? And if the risk premium that the Bank of Canada has to give out to other countries to maintain our debt is that going to have just the opposite effect this time? Is Canada going to be one of the rare places in the world, maybe in alignment with of the United States, because the United States economy could handle higher interest rates, and really they should be raising theirs because their house price bubble now, their next house price bubble, which has been underway now for 3 years, is getting bigger. We could see rising interest rates forced on the Bank of Canada as a result of no one wanting to take Canada bonds. What you saw to news was CIBC issued the first negative bonds, I believe, in that bank's history. So clearly the trend is towards lower bond rates, which normally means lower mortgage rates. But the Office of Financial Superintendent, the Minister of Finance, does have levers that even if they wanted to lower interest rates, consumer rates, that your mortgage rate effectively would not fall in line with any further rates. Whether the Bank of Canada would use those levers or not, I don't know. My personal belief is that the Bank of Canada is not even aware of how they can use those levers based on my interactions with the government and the last 3 ministers of finance.
Is offshore buying still a strong influence on the Vancouver market?
No. But that changed in June. Okay, so that was an overnight change. I'm going to leave it to the lawyers and to the foreign the students of the Chinese economy, because the Vancouver market was disproportionately impacted by Chinese funds, as I've said in your radio show before. But even the Ponzi scheme of money laundering, the flipping of properties, which, by the way, anybody who questioned our theory on that only needs to see the difference between the Terranet National Bank house price index for Vancouver and the average selling price in Vancouver changed year over year.
Ross, when you mentioned money laundering, right now the Chinese government is going after an individual who owns 3 houses worth about $10 million, saying that they were acquired by fraud. So
exactly what I said.
Yeah.
You know, exactly what I said. This is the problem that I have. Why are we the only people in Canada who understand how housing markets function? Why is it that our intelligence, 6 months, 12 months out, is always correct?
The Chinese media now is warning that Canada's housing crash will be worse than the U.S. Is that going to be the end of Chinese buying in Canada?
Chinese investors, okay, are going to liquidate their real estate holdings and move the money probably into the United States. That would be the most logical thing for a Chinese investor to do. Whether or not they follow logic, I don't know. I think if you're a multimillionaire with millions of dollars, you're not a fool. If you've already made 60% or 30% on your property because you bought a $1.5 million house that is worth $3 million, you can afford to sell that property for $2.5 million and still pull out $1 million of profit. It's no skin off your teeth. The average person who would have purchased that house, the average Canadian, cannot do that. So what you happen when a bubble, this is why I say each bubble is unique. This specific bubble, there is so much foreign capital that has come into Vancouver and other parts of British Columbia that those people can withdraw that capital, even if they take a 10 or 20 or 30% hit on it, and still be massive winners as an investor. So yes, that's what's going to happen.
A survey of young families in Vancouver found up to a third of them plan to move out of the city within 3 years because they can't afford to live there anymore.
What are their expectations? I read an article in the paper today that someone had purchased an 800 square foot condo, had in 2013, had 2 kids, and now were complaining that they couldn't move into a townhouse because there was $150,000 spread between their place and the townhouse. Historically, the people that are 60, 70 years old, homeowners who have owned their homes for 20, 25, 30, 35, 40 years, they lived in their first home 12 years before they moved. The average Canadian only moves every 12 years. Who thinks that they have the right to live in a house for 3 years and for it to equal the gain that allows them to move out? The only people who believe that are people who believe house prices are going to go up forever and that you're going to see 30% year-over-year gains, or ones who can't get out a calculator and push the button and see how the numbers go up. People who are complaining, talking about moving to the outskirts of Vancouver, they should have moved to the outskirts of Vancouver 5-7 years ago. And right now, as the housing market turned, they could have been moving back into Vancouver after paying the commuting price in the last 5 to 7 years. Instead, they stayed there, they rented, they followed all the bad advice that everybody has been given in Vancouver, the poor homeowner advice, which is why people are retiring in destitute in Canada today after owning a house for 40 years, because they didn't follow a normal progression how every young family moves. You accept less, and over time you get a better job, you pay down your mortgage debt. You're not hoping on your house price to increase in value and then move. No. You're going to actually pay down your mortgage debt. You're going to have your wages increase so that 8-9 years later, you can then move and afford to be able to buy a bigger home for your family. That's the way housing works. No matter what anybody wants to do, there is no way to avoid that process from happening.
Has the movement of people out of Vancouver raised prices in the rest of BC?
100%. But this is common in every housing market. When you have a housing bubble, as we have in like a big bubble, as we have in Vancouver, as we have in the GTA, okay? People move a little bit further out. In other words, I can't afford to buy a house, a townhouse in downtown Vancouver, but I can afford to buy a townhouse out in Surrey or Langley. What's the trade-off? Well, if my job is located in New Westminster, I'm going to have to travel a little bit further than I would if I bought in Burnaby, if I decide to buy out in Langley. That's just the compromise that young families make. And the really lucky ones, the ones who get the really great jobs, the ones who start to make really big money, at some time they may move back into Vancouver. Others will make their life out in Langley. It's still Vancouver. It's still British Columbia. It's no different than me out here in Burlington. If I wanted to have my home in Toronto, it would cost about 1.5 times more than it would have cost me in Burlington. I'm not stupid. I'm not going to move to Toronto and do that. I set up my life and my family in Burlington, commute when I need to Toronto. I've never worked there, but that's what every other family in Burlington basically does. And those are the compromises that you make if you want to own a home.
What's the difference between a real estate speculator and an investor, and do they react differently when a housing bubble bursts?
Of course. So the wealthy homer actually has two investor streams. Because that's also part of our program. We have the speculator, which we call the flipper. And then we have the long-term investor, who's going to hold on to that real estate and never, ever sell it. They will never, ever sell that home while they're living. They will own that investment property every single day that they're alive. And on their death, that investment property will pass to their kids. What the long-term investor does is he sets up the arrangement so that once he gets 20 to 25 years out, the mortgage is paid off, and he or she starts receiving a monthly income from the property. Now, the problem that we have historically is that money is taxed, but it's a steady stream of cash flow that really cannot be beaten any other way. So that's what the long-term investor does. The flipper, he asks us to say, look, which markets do you guys say are going to increase the highest over the next 12 months? In some cases, as you've seen in BC, we've had people who've done it in as little as 3 months. They'll purchase the property because they know that the price velocity of the property they're buying is on pace to return 20 to 30% increase over the next 6 to 12 months window. knowing that price velocity where it's happening, and knowing that the type of home they're buying is the proper type of home to flip, they make immediate gains. We have people who purchase properties, hold them vacant, keep the property vacant, and then flip it to someone else. And this is all legal. They close on it, they pay land transfer tax, they pay real estate fees, they report it on their taxes, everything. And they still walk away with 100% gain on the amount of money they invested. Those are flippers. What a flipper does, though, differently than an investor. So what a speculator does differently than an investor, is they liquidate the second they're going to lose equity. The second they're going to lose money, well, we tell them. We say, look, you guys are now on pace to go negative 8 months from now. So starting about 4 months from now, they'll list the property and get it sold, because they're going to get all the gain they can out of the property until that threshold is met. Those are speculators. Anybody who holds a vacant property, including all those vacant properties in Vancouver, are speculators. Anybody who purchased a second condo, as CMHC recently released the news, and then CMHC once again misinterpreted how homeowners or investors interact with their real estate, those people, they bought those homes on spec. You bought a pre-sale property that is not going to even be built for a year or 2 or 3 or 5 years later. That is a 100% a speculative purchase, because you don't know where the market's going to be 1, 2, 3, or 5 years later. Those people, as happened in the early 1990s in the Greater Toronto area, all of a sudden they find that the projection is they're not going to be able to rent their property for what they were told they could rent it for. It's going to be worth less money than what they told it was going to be worth by the time it was finally built. And those people en masse list the properties, and that causes even further housing bubble to pop even more rapidly and with more volatility.
What is Emily, E-M-I-L-I, and what effect has Emily had on the housing bubble?
Well, Emily is the reason we have a housing bubble in Canada. The Canadian government, through CMHC, in the mid-1990s, created an electronic appraisal process to measure risk when lending mortgage money. That piece of technology was called Emily. The day it hit the market, it was wrong. It is still wrong now. What are we? We're almost 20 years. I think you're almost 20 years into it. 20 years? Anyways, what I think it was around 97 it came out, and yeah, so that's 20 years. Wow. 20 years later, it's still flawed. The only way to know what a property is worth is to call up a licensed appraiser and demand that a full, we're going to use the Canadian version, US PAP appraisal is done in the property. That is the only way that house price gains are kept in check. What Emily does is, Emily says, okay, the bank says, we've got somebody here who's got has $300,000 down, and they want to buy a $1 million house. They call up CMHC. CMHC plugs the numbers into Emily, and Emily shoots out an electronic from their algorithm whether or not the house that the person is going to buy should be worth $1 million. The bank says, okay, he's got $300,000 down. That's a 30% down payment, only a 70% loan-to-value ratio. Emily says it's okay. Now the office of the superintendent of financial institutions is going to be happy because we're complying with their guideline. Get the money out. Let's lend it to them. The reason the bank doesn't have to worry is there's $300,000. That house can take a 30% house price correction, and the person will not get rid of it. that house can actually take a 40% house price correction, and the homeowner will not get rid of it in Canada. That's just the way it is, the way the system operates in Canada. So what Emily does is Emily says he wants to buy $1 million house on Smith Street. That two of the neighbors' houses sold for $1 million on Smith Street. Okay, $1 million makes common sense. We're gonna say that's a low risk mortgage. Had you hired an appraiser and had the appraiser go out, the appraiser would have said, wait a second, this house is a corner lot. We're going to take a $50,000 reduction in adjustment on the price. Wait a second, this house has a kitchen that was installed in 1995, but the other two that sold, they had kitchens that were built after 2010. We're going to take a $40,000 adjustment. The appraiser says, oh, the fence in the backyard of this house looks like it needs to be repaired. The other two properties that sold, oh, their fences were in good repair. We're going to take a $3,000 adjustment. Emily doesn't take those adjustments. CMHC and the banks made the biggest mistake in Canadian real estate history the second they went to an automated evaluation process. Now, they could have created that logarithm so it would have been the other side of the coin. In other words, sorry, we're only going to lend you $850,000. We can only say that house is worth $850,000, not the million. And if you want to get more money on it, you need to have an appraiser go out and verify it. CMHC didn't do that. They went ahead with Emily, and Emily has created false appraisals across Canada. The reason it creates false appraisals is because Emily never takes out the surplus. Housing market goes like a roller coaster. It goes up, prices go up, then they go down. Now, what I mean by up and down is they'll go from 1% year-over-year gain, 2% year-over gain, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17.67 in British Columbia, and then the next month they drop to 16.69. 15, 14, 13, 10, 9, 8. Whoops! Real estate agents convinced everybody it's a good deal. Now they start going back up again. So it never clears the surplus. Emily never takes out the surplus. The only people who ever take out the surplus are licensed professional appraisers who do an appraisal exactly by the definition of the USPAP.
What is multiplicity, and how does it apply to today's real estate markets?
Multiplicity of sales. That's what I talked about earlier about the trading cycle. In May of 2013, every first-time buyer that bought a house in British Columbia, there was basically two other sales that took place because of it. Those sales were able to take place because there hadn't been a whole bunch of house price gain up until May of 2013. As a market goes forward and those first-time buyers' share of the sales shrinks, that means the average selling price increases more rapidly. In order for people still can't jump a $200,000 mortgage. Maybe they can only jump $150,000. So what happens is they don't buy the house that's $200,000 more. They only buy the house that's $150,000 more. And that's the way you get more trades. We call it the sales chain, which is the multiplicity of trades. So right now in Vancouver, for every first-time buyer that buys, you've got about NBC. You've got about 5 trade-up buyers that are moving as a result of that. That's how your house price gain intensified right up until May of 2014 or 2016.
When a housing bubble bursts, do the banks continue to be the friendly place where you can easily borrow money?
When the housing bubble bursts or the housing market starts to correct, bank CEOs pass down the line instructions. I'm not going to get my profit shares, my bonuses, if this bank does not turn a profit. We need to start squeezing all of those homeowners at every opportunity that we get. This is why a consumer, the wealthy homeowner, never ever goes to a bank to get a mortgage renewed, have anything to do with borrowing money on their home. They use a mortgage broker that is following the wealthy homeowner standards. You walk into the bank, and the bank says to you, let's say your house price is corrected 20%, and now you used to have 25% equity in your house. That equity now has dropped to 5% because a 20% correction took place. Now remember, this correction is artificial. It's an illusion, but everybody believes it. The bank says, wait a second, you only have 5% down now on your house. Your house is only worth $100,000, and you've got a $95,000 mortgage. And you say, yeah, but it's the same house. It's the same mortgage payment. Interest rates haven't gone up. Oh, no, the bank says. We have a higher risk premium. And actually, in your case, because you only have 5% down, we will renew your mortgage, but we're only going to renew it if you get CMHC insurance on your mortgage as a high-ratio mortgage. That's what happens in a house price correction. That is exactly what happened in the early 1990s. The banks started to squeeze people, and they squeezed them so tight that people had to sell their houses and get out of the market. They didn't walk away from them. Canadians don't walk away from their houses. They sell them and move on. You cannot trust a bank because a bank owes its responsibility to the shareholders of the bank. I personally think that the Advertising Standards Council of Canada should not allow a bank to pretend that they're nice guys, that they're your friends. What a bank wants to do is get you so in debt and for them to get so much control over you that then they can force you to accept higher interest rates, pay higher fees, stay with the bank because now you can no longer leave the bank. See, this is what happens in a house price correction. When you only have 5% equity left in your house, you no longer can just move your mortgage to another property. When you have 50% equity in your house, when you have 30% equity in your house, when you have 25% equity in your house, you can go get a mortgage from any lender you want. They will fall over backwards to give you the best terms. The second a housing market begins, a correction begins, and the banks are afraid that the housing market is going to get worse, the banks will do you no favors. This is why, I know this is self-promotion, everyone should be a member of the Wealthy Homeowner. Again, it costs you nothing. If we don't deliver more, you get your money refunded. That's how 100% positive we have no risk in our program. You can only deal with a mortgage broker as a wealthy homeowner. You cannot walk into a bank. If you want to walk into a bank and deal with the bank, you can no longer be a wealthy homeowner. Your membership is terminated because we will not have a failed wealthy homeowner. Our entire reputation on this program, the Wealthy Homeowner Programs, is built on a person. We will never have a member of the program lose a nickel. So you can't even, there's a qualifying process that you want to go through. If you say, yes, I'm going to get my mortgage from the bank, I'm not going to use a mortgage broker, then you will not even be accepted into the program. We will not take your money. You have to say, yeah, it makes common sense what you guys are saying. Okay, if you're telling me that I can save an extra quarter of a point by using a mortgage broker, and that you're saying that this is the type of mortgage that we should be looking for, and yeah, maybe we don't agree with that mortgage, we want another kind, so you say these are the terms that we need to be looking for, yeah, we'll do that. Our number one clients are accountants and engineers. That's how awesome the program is.
Do Canadian banks disclose their exposure to uninsured mortgages and HELOCs, HELOCs, and are the banks at risk?
The banks are highly at risk, but they're at risk because of Emily, number one, and they're at risk because they have lied to their shareholders in their quarterly and monthly reports where they disclose their loan-to-value ratio on all the uninsured mortgages that they're currently holding. In British Columbia, the Teranet National Bank HPI aggregate, in Alberta, has dropped about 3% for Calgary as this correction has rolled out. Canadian banks universally rely upon the Teranet National Bank HPI on a forward sortation area breakdown, in other words, postal codes, to determine what the value of the properties that they hold mortgages on have changed. Why has the Teranet National Bank house price index not reflected the 18% decrease in value homeowners who are successfully selling in Calgary today are forced to take? It's because the Teranet National Bank house price index is the same flawed methodology that is used with Emily. So the entire loan portfolio in Alberta for all Canadian banks that is disclosed in their quarterly documents to shareholders is artificially inflated right now by 15%. So if the bank says our loan-to-value ratio on all of our uninsured mortgages in Alberta is 62%, what I'm telling you is it's really 77%. What happens when it gets in British Columbia, where there's far more room for the prices to drop far more rapidly? You got to remember, Alberta really has seen no price gain. It hasn't even keep pace with inflation since the late 2000s when prices first got bumped up there. British Columbia, on the other hand, has seen massive gains. They have massive mortgage exposure right now, the banks in British Columbia. You can see that in the $2 million I told you of capital that had to be added to the Vancouver housing market in April. That's $2 million, which equates to another what's that? 1.6 billion in new mortgage debt. So those loan-to-value ratios that the banks are using to their shareholders, in my personal opinion, are fraudulent. You'll notice that the Office of the Financial Superintendent took action this month on that topic as they changed their guidelines on risk. It wasn't just on income qualifying. It was also on how they are evaluating their properties. Those directions from the Office of the Superintendent of Financial Institutions came 12 months after we sent him a letter, which he responded to us, which we have in PDF format, thanking us for informing him of what the situation was and that his team was going to look into it.
How many real estate agents are there in Canada right now, and how many agents do you expect there to be after the bubble bursts?
Right now in Canada, there's about 117,000 real estate agents who are members of the Canadian Real Estate Association. There are about another 22,000 that are not members of the Canadian Real Estate Association. Everybody thinks it's just real estate agents have to be members of the Canadian Real Estate Association. They don't. Anyways, long story short, you're sitting at about somewhere around 140,000 in total. But what you're going to see this time, Jim, is that as you're finding out in British Columbia, real estate agents are not qualified to earn the commissions that they earn. They're qualified to earn $2,000 or $3,000, $4,000 maybe on a real estate transaction. They are not qualified to earn $20,000, $30,000, $40,000. They do not have the training. They do not have the expertise. Most real estate agents have not even taken an advertising course in their entire life, let alone think they can write. In my province, real estate agents are not even legally allowed. So in Ontario, real estate agents legally are not even allowed to appraise a house. The reason they're not legally allowed to appraise a house is because they don't have the training and education to appraise a house. What you're going to see the agents have benefited from this house price bubble because the change in the industry that was on pace in 2006, 2007, and 2008 stopped. The real estate industry in no way is going to resemble what it is today after this house price correction rolls out. My expectation is that you're going to have maybe at total between 40 and 50,000 real estate agents across Canada after 10 years from now when this is all finished out. And those real estate agents will not be doing what they're doing now. They will be paid far less than what they're doing now. They will have become far more educated, far more professional. The consumers will no longer be lied to. All these economists at your real estate boards in Vancouver, they'll all have been fired and kicked out because they added to the problem. That's what's going to happen.
Ross, how can people find out more about the Wealthy Homeowner Program?
www.thewealthyhomeowner.ca. They can go there. The program's laid out. We have an introductory special right now because of the housing bubble that's out there. We want people to take proactive action. And don't get me wrong, Jim. Your listeners, there's lots of positive, proactive choices that they can make to protect themselves as this housing bubble pops. They are going to lose home equity. What the wealthy homeowner can do is allow them to protect some of that home equity and for them to recover from the loss that's taking place. What the wealthy homeowner does is each individual homeowner is profiled and their specific homeownership position is determined, is laid out and reviewed. We then offer them solutions that they can choose to go forward. They pay a monthly fee of $29 right now. That's all that it is. And if we don't deliver $360 worth of savings to you in a year, then you shouldn't be signing up with us anyway. I mean, we're talking about a 0.01% difference in mortgage payment. We're talking about never getting your property taxes lowered. We're talking about not buying your house with a home warranty, not buying your house, getting a $3,000 TFSA back to you. Those are all what the wealthy homeowner deserves. Canadian homeowners, we're looking at about 14 million of them right now, deserve to be treated with the respect that they have exhibited by making those mortgage payments all those years. There is only one place in Canada where your home equity can be effectively managed, and that's the wealthy homeowner.
Ross, thank you so much for being on This Week in Money.
Thanks a lot.
My guest has been real estate consultant Ross Kay from thewealthyhomeowner.ca. And that wraps up our show for this week. Thanks to our guests, Ross Clark and Ross Kay. And thank you for listening. Questions for the show can be emailed to info@housestreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.